17 of 21 series are aligned with a stagflationary configuration this morning. That is a moderately strong, but not extreme, level of agreement across the engine. The current macro regime is stagflation strong, with a confirmation score of 17 out of 21. In regime terms, the engine is observing a macro regime where growth momentum is decelerating at roughly minus 0.16, while inflation momentum is accelerating at roughly plus 0.02. That math means the underlying series the framework uses to proxy economic activity are softening on a rate of change basis, while the price series that stand in for inflation pressures are tilting higher. The coherence score sits in a moderate band, and the same 17 out of 21 series that showed up in the hook define the confirmation score. By our framework's reckoning, regimes with this level of confirmation have persisted in about 41% of comparable instances when you look out over 3-month windows. Historically, when this stagflation label has been active with similar math, broad equity indexes have tended to chop with a mild defensive tilt. Real assets have often held value, and long bonds have faced intermittent pressure. A description of past behavior, not a roadmap. Compared to a week ago, the confirmation count has stayed in a similar band, while the improvement in the Chicago Fed Activity Index has slightly softened the pure downside growth message, an evolution the engine captures in the growth momentum value rather than in the label itself. Let's work through 4 of the signals that sit underneath that top-down read, starting with interest rates. The 2-year Treasury yield, which is the market's cleanest real-time proxy for Federal Reserve policy expectations, sits a little above 4.2%, while the 10-year Treasury yield is around 4.6%. That leaves the spread between them modestly positive. The engine tags the rate structure as yellow, meaning a mixed but watchful configuration where growth momentum prints negative, while inflation momentum prints positive in the same window. In our framework's reading of comparable periods, this roughly coincided with more range-bound Treasury returns and modestly pressured long-duration assets over the following 1 to 3 months, an observation under our methodology, not a forecast. For investors, the question this raises is whether that combination of yields and curve shape changes how much duration risk they are comfortable carrying. What would challenge this read in the math is a decisive move in the 10-year back below the policy-sensitive 2-year, or a break in inflation proxies that flips the inflation momentum sign. On the labor side, non-farm payrolls and broader employment measures still point to a labor market that is softening from tight conditions, but not yet flashing outright stress. The engine interprets this as a yellow labor signal. Job growth is slowing, but not collapsing, and unemployment measures remain historically low even as hiring momentum eases. Labor data matter because they sit at the intersection of growth, inflation, and policy. Wages feed prices, and payrolls influence spending and corporate margins. In our framework's reading of comparable periods, this roughly coincided with corporate earnings that drifted rather than surged, and equity markets that spent time debating the depth of the slowdown over the subsequent quarters, again, a record of past behavior, not a forecast. The practical question for a risk taker is whether this labor profile confirms or challenges the way earnings are currently priced. A sharp reacceleration in hiring, or conversely, a meaningful rise in unemployment would be the kind of development that has historically shifted the engine's reading of this signal. Credit is the third pillar. The Federal Reserve's latest survey and balance sheet data point to bank lending that has grown in the first half of the year as standards eased somewhat, even as conditions remain tight for small businesses and households. For the engine, that combination of expanding credit volumes but still restrictive terms reads as a yellow credit configuration. Markets pay attention to this because credit is the channel through which macro conditions reach real activity. When banks are cautious, growth momentum often softens in our math. In our framework's reading of comparable periods, this roughly coincided with slower but not collapsing investment and consumption over subsequent quarters, an observation under our methodology, not a forecast. The question for portfolio construction is whether this pattern lines up with how risk assets across credit and equities are currently trading. A meaningful loosening in lending standards or a break in credit demand would be the sort of shift that, in prior cycles, has altered this signal's character. The fourth signal today comes from the mix of equity sectors and commodities. Technology shares have been strong, but overnight futures point to pressure after last session's broad artificial intelligence rout, tied to new competition headlines from China. At the same time, gold is firm and crude oil is up, reflecting a combination of renewed geopolitical tension and energy-sensitive inflation worries. The engine tags this equity plus commodities pattern as red on the growth versus inflation axis, with the quantitative definition being that inflation-sensitive assets, such as energy and precious metals, are advancing faster than growth-sensitive risk assets. In our framework's reading of comparable periods, this roughly coincided with choppy equity markets and sturdier performance from real assets within 1 to 3 months, again, a record of past behavior, not a forecast. The question this mix raises is whether the balance between growth stories like technology and real asset strength is consistent with an investor's own macro view. A clear rotation back into cyclical sectors with weaker real assets would be the kind of shift the engine has historically read as a challenge to this configuration. Inside the conditional map, 2 if-then structures stand out. If the 10-year Treasury yield crosses 4.45% and holds that level for 5 consecutive sessions, in our framework's reading, the inflation composite historically showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. In regime terms, that kind of sustained move in long yields has often appeared in past transitions where inflation momentum stayed firm or strengthened, even as growth remained under pressure. If the fear and greed sentiment index drops below 15 and holds there for 5 consecutive sessions, in our framework's reading, the regime confirmation score deteriorated in roughly 7 of 9 similar conditions. Again, a historical characterization, not a forecast. Under our methodology, that kind of sentiment washout has often coincided with the engine flagging a regime watch state rather than clean persistence. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated, rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use Atlas to study how the framework has recorded conditions across prior environments as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. This is all potential, educational by construction. The math describes configurations and past behavior. Any decisions remain with the viewer. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members.